Hey, what is up guys? If you're new here, welcome. If you're not, welcome back to our weekly US market updates, where I bring you updates on macroeconomics, earnings, and all things happening in the stock market so that you can get up to speed with the market in just a few minutes. So last week, the S&P 500 was choppy but still ended up in the green, mainly because of the big techs like Microsoft, Apple, and Tesla losing their valuation during the week. And it's the first time that Apple's market cap has fallen below the $2 trillion level since 2.5 years ago. And not gonna lie, I never thought I would see it fall past to my cost price again, and apparently here we are today. But the reason why Apple and Tesla has been hit so hard for the past few weeks is mainly due to the pandemic situation worsening in China. Literally all the people that I know from China has gotten sick in the past 2 weeks. Pretty insane, but more about Tesla and Apple in just a bit. The 10 to 2 year yield curve, it's been some time since we visited this chart. It's still deep in the negative territory and shows no signs of rebounding at all, because the FOMC meeting minutes, which was freshly released last week, shows that no participants anticipated that it would be appropriate to begin reducing the federal funds rate target in 2023. And this means that the Fed is still hawkish and not anywhere close to being done with the rate hike yet. So it's only right for the fear to be reflected in the stock market as well as the deeply inverted 10 to 2 year yield curve. Oil prices, we are still in the mid 70s region, which is rather low compared to the 90s 2 months ago, mainly due to the increased risk of recession after the US jobs report was released last week. But in case you missed it, I've made a video explaining the potential trends in the stock market this year, and one of it includes a potential bull run for the oil market, so feel free to check that out. And speaking of jobs report, we got it last Friday from the US BLS, and the US economy added 223k non-farm payrolls in December, which is 11.5% above the analyst estimate of 200k, and the employment rate fell to a near record low of 3.5%, and boy, that probably pisses off the Federal Reserve because they have been waiting and waiting to see the jobs market to show signs of breaking up. But nope, we got a stronger job market. Okay, but not all is lost. Not all is lost, because the average hourly earnings, or aka the wages, increased 0.3% month over month in December. But they have reduced their growth to 4.6% year over year, which is a 0.2% drop from the 4.8% growth in November. So that was helpful to bring down the inflation. And we've also got the December Purchasing Managers Index PMI data for the manufacturing sector. It is now down for 2 consecutive months to below the 50% mark, which means businesses are forecasting a continued decline in consumers' demand when it comes to purchase of goods, and I'm sure you can relate already. And another version of the PMI for the services sector also came in much lower at 49.6%, which is a drastic drop of 6.9% from November's 56.5%. And in simple terms, businesses are expecting some sort of economic storm to land earlier than expected. And keep in mind that this is all expected because higher rates for a prolonged period means there will be weaker demand, and if that continues, it also means it will also help to bring down inflation as well. But the rate at which the services PMI plunged in December, that's pretty concerning to me, not gonna lie. Quick pause, you can support this channel for absolutely free by checking out Interactive Brokers in the pinned comment down below. Start trading with the most reputable and well-regulated broker that allows you to trade fractional shares in the US, for which many other brokers don't offer. And the best of all, their fee package is easily one of the cheapest among all other stockbrokers. Thank you so much. Okay, back to the video. And speaking of weaker demand, Tesla is counter-reacting by cutting their vehicle prices in China, Japan, South Korea, and Australia. But more importantly, we focus on China, which makes up about 23% of their total revenue. They are bringing down the price of their made in China Model 3 and Model Y, which are two of their best selling vehicles since they are more affordable to the mass market. And this is by far the biggest percentage drop in their car prices that we have ever seen in recent history. So naturally, lower average selling price, or ASP, will translate to higher volume of cars sold, because Chinese car buyers now have a better proposition to consider Tesla in their purchase decision as compared to other buyers like BYD and whatnot. But of course, it comes with the negative consequences to the Tesla's profit margin, and hence why you see the sell-off in Tesla's share price last week, or even for the past couple of weeks. And a research by Pierre Ferragu shows that with Tesla's ASPs down an average 8%, will drive sales volume up by 36%. And because their vehicle prices are now lower and competing in the lower budget segment, their total addressable market TAM will grow from 20% to 50%, which means they will be eating into the pie of the total US car sales, and same goes to the total Chinese car sales. And peers said that Tesla can lower their selling prices without hurting their margins because Giga Berlin and also Giga Texas is improving their average unit cost since they are ramping up production, and there are subsidies in the US in the form of EV tax credit plus the shipping improvement from China to Europe means they will also be able to improve supply and input costs as well. I don't have the numbers to forecast as to how much the margin will drop, so your guess is probably as good as mine, but to say that their margins won't hurt because of the volume growth to me is just a little bit too optimistic. Just putting it across in case any of you misunderstood me. But anyways, the point is Tesla has a very strong pricing power here since their auto margin for the latest quarter is 27.9%, which means they still have a lot of room to compress their auto margins, and this will inevitably translate to a lot of pressure to the competitors to drive their prices down as well. And don't be surprised to see other EV players having to start selling their vehicle at a loss. And over on Apple's camp, we also saw smartphone sales in China fell by 21.7% in November, while another source quoted Apple's iPhone shipments have declined by 22% year over year in the December quarter, mainly due to labor shortage caused by the virus outbreak at their Foxconn Zhengzhou plant, and this could potentially break Apple's 14-quarter revenue growth streak for the first time, and hence why the fear is probably or already reflected in its share price. And another thing that you need to know is Apple is rumored to be behind schedule for their AR/MR mixed reality headset due to some technical difficulties, and is expected to ship them later this year. So we probably won't hear any announcement on that in the coming Apple Spring event in March. It's not the end of the world because from my last calculation, this segment size is probably about $3 to $6 billion in revenue in the first 2 years, so it probably wouldn't move the needle too much anyway. But a good thing for their supply chain is that they are now diversifying from Foxconn by awarding a bigger contract to their current iPhone 14 Pro Max partial supplier, Luxshare Precision from Kunshan, northwest of Shanghai. And fun fact, the founder of Luxshare is an ex-Foxconn factory worker, and she is now the second richest woman in China. Not that it matters, but personally if you ask me, I'm not so concerned about it because we will eventually recover from it. And can we see a lower share price for Apple? High chance, but I will also see it as a buying opportunity for them in the coming months. So upcoming important dates for this week, all eyes will be on the CPI inflation data released on Thursday, and the market is hopeful to see a drop of CPI to 6.6% from the current 7.1% level. And also it's January, and guess what, we will be kickstarting the quarterly earnings with banks this week. So do subscribe and stay tuned for more earnings call updates in the upcoming Monday videos. Thank you so much for watching, have a great week ahead, and as usual, I will see you in the next one.